Hi everyone, it's Brian from Stockcalc. In this short video we're going to go through the quick DCF tool, or the quick discounted cash flow tool we have on the site. If you want to access the entire site, try a demo of it, simply click Try Stockcalc now and provide your email address, and we will forward you an email with instructions to activate the full site. This site is set up to allow you to try these three different tools: the screener, the quick DCF, and the weighted average cost of capital. Quick discounted cash flow tool is in place to allow you to basically do what-if scenarios, to test some assumptions, to look at things like growth rate and cost of capital and see what their impact are on the value per share calculation. So I'm going to do a demo here with General Electric. I'll type GE into the box, select General Electric from the drop-down, and let the calculations load. You can see there are a few default values that we have. Growth rates in years 1 to 3, growth rates years 4 plus. So we have 5% growth rate in years 1 to 3 and 3% growth rate from years 4 plus. We have a weighted average cost of capital value that's been mass calculated for all of the companies in the database, for the almost 9,000 companies that are there. So this is to only be used for testing purposes. It has not been validated. We grab the free cash flow directly from the database, use all of this information to calculate an enterprise value for the company. We grab the book values of interest-bearing debt and preferred shares, subtract those from the enterprise value to give us the common equity in this calculation, and divide that by the number of shares outstanding to come up with a value per share. So the purpose of this tool really is to test the what-if scenarios. So what if growth rate is not 5%? What if we think it's only going to be 3% on a go-forward basis for the next 3 years? Our value per share would go from $26.75 to $24.69. So somewhat of an impact, but not huge. If we looked at the weighted average cost of capital changing by 1%, for example, it would go from $26.75 and it would cut it in half to $12.56. So a very significant impact, very sensitive to the cost of capital. So that's the purpose of the quick DCF, to allow you to look at the different elements that are involved in the calculations and to look at what if. Again, for a full demo of the site, simply click the Try Stockcalc Now button and provide your email address, and we will gladly forward you an email to give you access to this full site. Thank you for using Stockcalc.